Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from somewhere sunny, Dimitri
Good
Pargamanik. How you doing, D?
good morning, Will. How are you?
Good. You want to start with a disclaimer?
Yeah. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your RIA, registered investment advisor, call your broker. That's what they're there for, to help you, give you advice, provide you with guidance. There's the disclaimer.
Excellent.
I'm going to share my screen. While I'm doing that, as a note to anybody joining us for the first time, Will and I, we do these shows in the morning to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read them back to me. We do provide a link to Zoom if somebody wants to come in and ask their question live. If you click on it, you go over to Zoom. Once you're logged into Zoom, there's a button, raise your hand. That signals to us that you're trying to ask a question, and then we'll let you in. But just keep in mind, if we let you in, we never know what the questions are, what the person will say. So just, be respectful with the questions and there are other people in the community trying to learn. So once you come in, just keep that in mind. So while we're waiting for more people to join us and give a chance to people to type in their questions, we'll start out taking a look at the pre-market report, see if we can get some insights on what's trading in the pre-market hours, and then we'll move on to the questions. Okay, well?
Yep, perfect.
So pre-market, these are stocks trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 39 stocks made our percentage gainers list, 152 stocks on our percentage decliners list. So from here, it looks like right now the trading in the pre-market hours is setting up with some bearish sentiment. Let's look at it from another perspective. We'll come up here and we have this calendar view. Today is September 7th, and this is giving us some stats from a high level. We have 226 stocks that are trading in the pre-market hours higher than previous day's close. We've got 487 stocks trading lower. As far as volume, we have 86.9 million shares trading on up volume versus 67.5 million shares trading on down volume. If we convert that volume to dollar value, because not every share is the same price, we have $457 million worth of stock trading higher versus $3.4 billion worth of stock trading lower. So this also indicates so far the trading in the pre-market hours is signaling bearish sentiment. Okay. One more check, and then we'll move on to the questions. When we take a look at this report, we see that there are symbols in there that are low cap stocks, ETFs. It could be a leverage product, could be a preferred stock. Any security that's listed on a major US exchange, if it's trading in pre-market hours and meets our volume, price, liquidity thresholds, it could make this list. And to narrow down this list to a smaller group of stocks, or you could use the filters here above. You can filter by your watch list if you created a watch list. I'm going to use this filter here in ETF. I'm going to click it, and when we click on that filter, we get a list of ETFs to choose from. I'm going to select this one, SPY. That's the S&P 500 ETF. And when you select it, the list below gets filtered by stocks that are holdings in the SPY ETF, right? Which are the S&P 500 constituents. And here we see one stock made our percentage gainers list, 28 on the decliners list. So again, this also confirms that overall the trading in the pre-market hours right now is indicating kind of across the board bearish sentiment. So I guess it's a couple minutes. I could go to the questions. You did say there might have been a leftover question.
Yeah, I think it was from the question was from Fred yesterday. He was asking on covered call, wouldn't implied IV be a useful back test along with delta to compare the number of observations? That was his question yesterday.
Okay.
We didn't get to it at the end.
Okay. Yeah, it's a good question. Let me start out with the covered call screener. I'm going to come down to here. I'm going to go into covered call screener, and let me bring up, I'm going to do a pre-filtered screen here. And let's screen by the highest market cap stocks for now. NVO, BABA. So on this screener, just to recap, what should we do? All right, we'll just stay on this. So on the screener, to recap, this is looking at a buy right strategy given the current. So it's looking at the current markets and taking the different call prices and saying, okay, if we did this buy right strategy right now, how does it look? All right, so let's just go maybe to, I'm looking for something that has a little bit more premium because some of these are 5 cent, 25 cent option. Let's do something like, let me just clear this and do maybe like Apple or something we all know, right? I'm going to just filter out for Apple. Okay. So in Apple, it's filtering out different possibilities for September 15th expiration. You could change this, expand it to next 14 days, 30 days, but let's stay on September 15th expiration. It's looking at different strikes and looking at the call bid, the delta of the option, how far away it is from the stock price. It gives you a couple more stats on this specific option. It's saying that this option right now has an IV rank of 46%. The way this is calculated is it's looking at, and you could look at it, you could read about it a little bit here, but what it's doing is looking at historically the implied volatility of a similar option in Apple, which means 7 days to go, this far away. It's looking in the database and saying, for this particular option, what is its IV rank? Okay, and that's 46th percentile, meaning in all our observations that 46% of the implied volatilities were below, 54% were above the current level. So we'll come back to this because I think that the question was the IV. But let's just go through all of this and then we'll get to the IV question. Here, it's telling you how much of a downside cushion you have until you hit break even. Because if you own the stock, if you buy right, you bring in premium. So the stock could go down, and the premium that you collect is like a cushion against some of your downside risk, right? So if the stock goes down, you're saying 0.6%, you're still at break even. Below that, then you start losing, right? So the premium no longer covers your losses. This is the time premium left in the option, and this is how much you would return if the stock, if that option expired today at this price. All right, so that would be your return on the total money at risk. Then we go to these back tests, and the reason we go to these back tests is from user requests. They were asking, well, if I'm looking at this buy rate strategy, and if I just did this same strategy historically over and over and over again, right? So if I found exactly 7 days to go in Apple, and I found a delta, an option with a delta that's close to 0.27 without going too far away, 0.27, and I just did this buy rate. How did it work out? Did over a long period of time, did this strategy pay off? Was it profitable? Was it unprofitable? How frequently was it profitable? How frequently was it unprofitable? And how does that compare to if I didn't do the buy rate strategy at all? So that's what these back tests are here right on the screen, right? So it's going through all this intense calculation, and it's doing the back test for each one for you. Okay, so this way you could see them, right on the screener. So I'm going to load this and show you how it looks, and then we'll go to the question of the implied volatility.
D, we did have a couple questions pop in about covered calls and puts.
Yeah.
Laurent asked, isn't a covered call the same as selling a put? And
Yes.
then Jackie asked, which one is better or safer, covered call or just selling the put?
Right. So a covered call is like a synthetic selling a put. It will mirror, each other. And we'll go to the options chain. I'll show you that. So a covered call is like a synthetic put. That's what it is. You're if you guys know put call parity, covered call is like a synthetic put, but there are some differences to be aware of with covered call strategy. Why you would want to do a covered call versus maybe a naked put. One of them has to do with maybe your cost basis, or if you've held on to a stock for a long time and it's subject to capital gains, you do a covered call strategy. If that stock gets taken away from you, then that creates a tax event, right? It's like selling your stock out. There are early exercise components to it that you want to consider, hard to borrow situations. So there are differences there that you want to consider, but in a frictionless market, they should be equivalent, or you create an arbitrage opportunity. Okay, so we'll go over that. But you're absolutely right. A covered call is like a synthetic put, like selling a synthetic put.
There you
go. So when we do this back test, really we're just going back in time and retrieving the data and taking a look at what the data, what does the data show? That's what we're doing. And you can see here that it went back in history, found 179 instances that were similar to what we're seeing right now in regards to the days to expiration. So the option has 7 days left to expiration, and the option has a similar delta. Okay, similar delta to where we're seeing right now, right? So you're never going to get an exact, snapshot, but if it's close enough. And then what it does is it takes that snapshot from the point, from the start, and it says here's the market at that time. So this option was 83 cents, 84 cents. The stock was 81.13, right? This was on August 23rd. This expired September 1st. So these are the end values on expiration. The underlying was 189.47. So this was in the money. So this strategy returned 2.6%, the buy rate. But holding the stock itself would have, without selling the call, would have returned 4.6%. So what happened was that the stock crossed, right, from 181.13, the stock crossed the strike price and increased to 189.47, right? So by another $4.47. But if you sell that call, you're essentially selling the stock, at 185, right? Because once the call gets exercised, you sell the stock at 185, you collected 83 cents premium. So you didn't make as much as you would have if you just held on to the stock in that instance, in that particular observation. So what we see is this, you would have just been better holding the stock, all right, if you just did it that one time. And then it goes back in time and does the same analysis, right, for each time. And it compares at that observation, what would have been better, the buy rate or just holding the stock? And out of all these observations, we get these summary stats that just doing the buy rate was profitable 65.4% of the time, but the average return was 0.6% and the median return was 1.8%. So how does that compare that if we just did the stock at those instances? Okay. At that, the stock alone from start to finish on those dates was a winner 60.3% of the time. So the buy rate had more frequency of wins. Okay, that it did have more frequency of wins, and it's probably because if the stock sat still or moved down, a little bit, then the buy rate provided that extra yield, extra cushion, extra premium that just holding the stock didn't provide. But what about the returns? So we see here that on average, just holding the stock returned 0.8%. So just buying the stock, selling the stock at those periods, if you did the same notional value, remember we're talking about you'd have to, at every time you would have to put on the same notional risk. Okay. If you did that, the stock only strategy returned 0.8% versus the buy rate 0.6%. Well, why is that? Because those times that Apple went up, right? If you did the buy rate, you didn't fully capitalize on that up move, because if it crosses that strike by more than what you sold that premium, well, then the buy rate strategy didn't fully capitalize on that move, right? Just some of that move. So you could see here that on average, the return was better not doing the buy rate. Even though you had more frequency of wins, the average return was better not doing the buy rate if you did this strategy just across the board, no matter what. All right. And you could see the median return here was 1.1%. The median return here was 1.8%. So what does this tell us? That this average got pulled up because you could see the median return for doing the buy rate is higher than the median return doing the stock alone, which is the 50th percentile, right? That's the 50th percentile return. But the average got pulled up because you had some really big moves, right? So the average could get pulled up because of those big moves to the upside, right? So that's how this is shown. But as you could see here in our data, we included everything. If there was earnings, right here, we included that too. We just said it doesn't matter. We're going to just put all the data in there across the board. And the question was, which is a good question, well, Now, how do I narrow down that data? How do I slice and dice it and put it into bins, right? How do I say, well, what if I just wanted earnings, or what if I wanted instances where there was no earnings? So that's already where you're trying to take the data and slice it and dice it further down. By the way, here we do have only earnings period. So if you just did the earnings alone, right? If we excluded non-earnings and just said, oh, well, you know what, I would have just done it around earnings to protect my position. Okay, because those are the earnings are have more uncertainty because we don't know what they're going to say. So maybe if you just did it around earnings and not earnings, how would that have performed? Well, here we could see that almost similar, 65.4% of the time, the buy rate was profitable for an average return of 1.6%. The stock was profitable 61.5% of the time with an average return of 2%. So here also the frequency of wins were lower, but the average returns were higher, just holding on to the stock without doing the buy rate. All right. So that's what the stats are telling us. So let's go then and say, so I think the question was, well, what if we narrowed down the data to certain implied volatility? So let's go to the options chain. Let's go to September 15th. And we want to go and analyze this further. We'll have to pick on the September 15th. I forget what was the strike, 187.5. So what we could do is go to the back test. We have to click on the back test, and I'm going to click on here. And this will retrieve for us. It's going to go back in time, go into our database, and look for options that are similar. Okay, so this one is doing it similar by distance away, 2.5% away above spot, 7 days to expiration. Okay, and I'm going to show the details here. These are the summary stats. When you hit show details, it brings up all the observations. Okay, so here you could see where the stock price was. This is the expiration, June 16th. So on June 7th, we took a snapshot, June 16th, this expired. This was the delta at the time, because right now we have it set to not by delta, but how far away the stock is from the spot price. But we can switch it to delta. Let's just stick with this for now. So it's going back in time and saying, okay, this is where the stock was. Here's the strike. It's comparing it. This is where the option was, 32 cents, 27 cents. This was the implied volatility, bid IV, ask IV. Let me do it by the delta maybe, because let me see if I can do it. Maybe doing it by the delta would have been just because I think that's what it was before. All right, so same thing. It's going back in time. Now it's matching it up by delta. Okay. So the snapshot was November 2nd. This was where the stock price was. We put in little indicators here if there was an earnings or dividend that covered that expiration. All right, so that's important. And by the way, we allow you right now to download this data for further analysis. This is the delta of the option. This is the strike price. And here we see what the premium was in there. This was the bid IV and ask IV. So now we're looking at the implied vols. This is the end value. The stock at expiration went from 111.73 to 108.43. The option expired out of the money, so it was zero, right? Because we're looking at the where's the strike price? Oh, strike right here, 114, right? So the strike price was 114. The stock finished at 108, so this option was worthless, right? So on the option itself, it was you lost 100% of the premium. Okay. Now, what if we wanted to, and these are the summary stats. 28% of the time it was a winner, but the average return was 26%. Why? Because here's the chart. You had instances in there where the returns were 1000%, right? Like sometimes these options here, right? Sometimes these options started out at 53 cents, like in this instance, May 3rd, but at expiration, it was worth $7.10, right? So you could see here where the stock went from 146.93 and ended 156.10. So why was the average return positive, even though the win rate was only 28%? It's important to know, yes, the frequency of wins was low, right? 28%. But still, when there were times where it hit and it hit big, that the average returns were still positive, 26%. So what if we could download this data and put in Excel and start, narrowing it down, because, we could take out earnings and dividends or just earnings and dividends. But let's, I think, use some of these tools here, and let's go to narrow down this data from up here. And I'm going to give it an IV range from 45 to 76. And I'm going to rerun the stats. So here, there weren't that many, 17 instances. So here, this is showing us that the call itself in all these instances ended up zero, right? Maybe over here, it started out 146. The end value is 52. Here, the end value is 49. So that's only looking at the call itself, right? There are, okay, I'm right up at 9:30, but I could continue this. But to start narrowing it down by the, implied vol, here's, we could do it here. You can download it and also do it in Excel, right? Because then you could slice and dice the data further. But I'm going to stop there, Will, because we're right up at 9:30.
Awesome, D. Their Chameleon community was talking about a particular ETF. Maybe you have some insight in how it's set up, or how to use the Chameleon to look at it. I'll pass that information. Maybe we can look at it tomorrow. It's TSLY. Awesome job, buddy.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons. We will see you tomorrow. And remember, after our morning show tomorrow, we have a webinar with Jake. I will put that link.
Oh, wait a minute, Will. Sorry, tomorrow I'm not going to be able to do the show. I forgot to.
Whoa, no show with D tomorrow.
No show. Yeah, no show tomorrow.
The chameleons are crying right now.
Yeah, sorry.
Everyone's
upset. I forgot. Yeah, I do have an appointment tomorrow that I have to make at 9 a.m. So it's exactly at 9 a.m. I can't do it tomorrow.
All right. So tomorrow we have Jake's show at 11 a.m. So that will be tomorrow. Again, I'll put the link in the chat, and that's to register on Zoom, but I'll put it out on YouTube. And I'll also send an email reminding everyone. So it'll be done the same way as the morning show. But that's going to be with the doctor at 11. He's going to be going over an earnings play he's been looking at. Anyways, D, great job. Thank you. We'll see
Thanks
everyone tomorrow.
everyone for joining. Yep. And